First of all, let me welcome all of you for coming. Thank you very much. I know you're quite busy this week, for taking the time to be here with us, not only this morning, but throughout the 4 days. But how do you think about what Ray just said? Some pretty harrowing comments, the idea that somehow we're going to have huge debt problems, great challenges ahead, we're not paying sufficient attention, huge polarization. How do you see the world, Anne?
So good morning. That was a nice introduction. One of my favorite lines is that I am an optimist that worries a lot. And I think if you look at all these, there's lots of index that measure the uncertainty felt by businesses and people around the world. And if you measure both economic and political uncertainty, it's never been higher. It's actually at the levels of 2008 or even 9/11. So, we are in a world where confidence is not there. And I think this is the single most important thing to remember. And of course, the things we can do about it and others we can't. As we're discussing, though, the world is in a very different situation from the 30s or even 2008, because at the end, what really makes this crisis very deep and really affecting billions of people, literally, is a global financial crisis. And I think that is not something, I think Ray was agreeing with us here off stage, that is in the cards. What he says, and I agree, is that we're in a world where you can see monetary policy, which, by the way, has really been very, very important. But the question is, from here on, is it as effective? There's growth issues, there's all sorts of different trends. And if we don't do new policies, if we don't take new measures, this is going to take us slowly down. And this is really what we should be working on. How do we get to a pattern of stable growth and higher growth, especially in areas like Europe? And I think there's not one solution. So I was remembering a panel with Ray in Davos 4 years ago. Christine Lagarde was there also, where we're discussing the 4 things we all know need to happen together, which is structural reforms, and he was mentioning that. Of course, that is a medium-term thing, effect, but hugely important. Fiscal policy, monetary policy, and by the way, strong banks. And I think we do have strong banks, but we also need banks that can support growth. And so finding the balance, especially in economies like Europe, where banks are so important for lending. I think those are the 4 things we need to combine, and how do we make them all work together so we can get to that stable growth? I'm not going to get into the political side, which is obviously very important.
Daniel, we all show up in Washington. The IMF offers a fairly pessimistic outlook, the weakest growth projection since 2008. I always like to come visit you in London because your office is right next to this huge trading floor. You're seeing the world through lots of different lenses. Is the fund right? Are they wrong? Are they missing something? Are you more optimistic? Is JPM more optimistic?
It's evident that the economy has been slowing down, so there is no doubt about that. But I'm not so pessimistic at all. So when you look at the United States, the consumer sector is extremely strong. It may have been slowing down slightly, but we have close to 70 million clients in the United States, and we don't see any change in consumer patterns of delinquencies in our portfolios or anything like that that will show that the economy is slowing down. And it's not a very different picture in Europe and in other places. Clearly on the corporate sector, mainly driven by trade tensions and the US-China relationship, there is a lot of lack of confidence there, and therefore that is being reflected in slower capital investment. So when you put all that, though the world has slowed, and then you have very supported monetary policy pretty much everywhere in the world. So I don't see the recession around the corner, and I don't see the markets being positioned in a way that is so bullish that they are going to, at the little bad news, it will collapse. Or all the opposite. The market is very long government bonds, very long gold. So the betas on equities, they are relatively low in the hedge fund space. So this, if there is some stabilization in the economy driven by some agreement in Brexit, some mini agreement between US and China on trade, I think that this slow growth will stabilize and probably will rebound a bit. Obviously, we are 11 years into the cycle of the United States. At some point, you're going to have a recession, but I don't see why either China or the United States a year before the election will want to create the environment to trigger that.
Takashima-san, we saw the poll on trade. Trade tensions an important concern of our audience, but also globally. As Daniel just said, the issue of capital formation is softening because of concerns about Japan. Trade is very important in Japan. How do you see the role of trade tensions and maybe the diminution of capital formation playing in Japan?
Yes, I'm always try to be optimistic, as Anna just told, but I tend to be less optimistic than the Daniel as a mediocre Japanese, and that is definitely the sentiment, business sentiment, but particularly in the manufacturing sectors in Japan and Asia Pacific, has been deteriorated, coming from mainly from the U.S.-China tensions. There's no question about it. But if we look back a little bit, the history of what we have experienced in the past, we have been always complaining about uncertainties, more or less. And perhaps what we are seeing right now is, of course, there are so many uncertainties, including some of those trade-related concerns, and that will, of course, tend to the deteriorated sentiment on the business side. But as Daniel pointed out, perhaps we should take a more objective view of the real fundamentals of activities in the world. And in that context, I still see the opportunities as the financial institutions, not just in the Asia Pacific, but on a global basis. So one lesson I really like to bring into the table is we always have to, the capabilities to go through all those challenges. Perhaps I stop, my comments here.
Wonderful. Jose, you've been a policymaker. You've been in Washington. You're now in London, but you've got a strong Asia presence. You have a great perspective from both the policymaking side, but also geographically. How do you see the world? And do you think the fund is being overly pessimistic?
Well, I think I would like to be put on the camp of those who are realistic, but still positive about the world. And sometimes when one reads the newspapers or watches TV, it is harder than one would like to be positive. But I think there are reasons to be positive. Let's see what the facts are. And I think that we always have to start by looking at the facts. And the facts are that the global economy is losing momentum. And this is something which is not new. It's been happening for a year and a half. And the main reason for that has been, of course, the US-China trade tensions, which have not only had an impact on trade, but also on confidence. And the confidence impacts are far larger than those that relate to the direct trade effect. And Anna was referring before to the importance of confidence. But the good news is that there is no recession in sight. The good news is that we are seeing some things happening, and Daniel already alluded to the partial trade deal between the United States and China, an agreement between the European Union and the UK government that now has to be ratified by both the UK Parliament and the European Parliament, so the jury is still out. But I think that those are signs of hope. And I think that although interest rates, low and negative interest rates, have significantly, adverse side effects that are felt everywhere in the world, but particularly in Japan, and Europe is behind. But it's true that overall, there has been a significant degree of monetary accommodation that has contributed to support the economic activity. The problem is that after the crisis, we have seen a significant reduction in the potential growth rate of all the economies in the world, both advanced economies and emerging markets, and that the structural reforms that are so much needed are just not happening. And that's a problem. And the second thing is that monetary policy can no longer remain the only game in town. So it needs to be complemented by fiscal policies whenever there is room for maneuver, And there are not that many places where there is room for maneuver, and by structural reform policies, which are politically hard to implement and governments shy away from them. So I think that that is what makes me a little bit more cautious about the future, which is that I don't see this realignment of policies that would take us to a better place. But in the short term, I think that we're still with growth, which is slow, but we are not falling into recession, and we have the ability to underpin growth, but that requires the political will of doing things on the non-monetary side that are not happening. And if these things happen, I think that the fears about the politicization of monetary policy will diminish. And if these things don't happen, that will remain or even increase. And that, I think, is a fundamental threat to the foundations of modern policy making that has served the world so well. So we're at a time where we may have the danger of redefining the rules, and I think we should be very careful, because we may go to a rules world or a world rules system which may not be as good as the one we had.
I'm going to come back to potential upside surprises. Shamar, welcome to the IF. You're our newest board member, and welcome to our programming. We're glad you're here. You're in the global capital business. You see capital expansion and capital formation all around the world, infrastructure, energy. Are we too pessimistic about capital formation globally? How do you see the story from your vantage point?
Yeah, well, look, first of all, I'd say, all of the other comments are very valid in terms of what's going on cyclically in the global economy, that we are in a position, as Daniel Pinto was saying, where in the advanced economies, the consumer is strong, and here in the US particularly, employment, wage growth. But at the same time, I think the trade and technology conflicts are impacting business investment and industrial production surveys around the world. And that's probably the thing, as the next 12 months progress, that could lead to the slowing in growth. And I completely agree that it's hard for monetary policy to respond when we have the next slowdown, because I think last time the Fed had a 5% drop in rates, and this time, the Fed fund rate is under 2%, European policy rates are -50, so there's less scope for monetary policy. And I do think fiscal policy is going to struggle as well because of the politics of the day. It's going to be hard for governments to get a mandate to respond. But my view in terms of being an optimist, like many of my colleagues here on the panel, is that there's constant structural change happening in global economies. Today, urbanization is a big theme. Climate change and responding to the energy transition, but a lot of other sectors, is a big theme. Technology and changing the way we move around and we consume everything, power, food, retail. So there's lots of places where communities need capital and expertise. And if you can deliver that, regardless of what's going on cyclically in the macro economy, you can deliver real returns to financial investors as well. We've got a huge pool of, there's 300 trillion of savings in the world in a very low rate environment that needs to find people like us in the financial intermediaries in this sector to bring capital to places where it's starved in expertise. And, as you mentioned, we're an infrastructure investor. Our infrastructure funds have been delivering 15% compound annual returns, not just over the 25-year, that's the 25-year number. Today, we're still able to deliver double-digit yields because you go and bring capital to developing water treatment in parts of China, energy transition, precision farming and agriculture. So the reason I'm optimistic is I think that, we as the business community or the financial services sector in facilitating the move of that capital can actually go and address structural need in communities and drive real return for all that capital that's forming, regardless of, the challenges we face in terms of monetary and fiscal policy's ability to respond.
Wonderful. Anna, $16 trillion worth of negative yielding debt out in the world. The yield curve in Europe is flat to downward sloping. The idea of maturity transformation, net interest margins, the principles of banking are under stress. How do you see a world where we have interest rates that are negative or low for not only a little while, but permanently? And how do you bank through that?
Well, we are present in 10 markets in Europe and the Americas. We have 144 million customers, Daniel, in these markets, compared to your 70 million in the US.
Yes. Well done. Congratulations.
Well, our customers are poorer, but they're getting richer. So, And no, but I say this, and now seriously, is that at the end, the macro is one thing, the micro is another. And when you look bottom up, I mean, we had the best quarter in, I think, 5 or 6 years to June. Our net interest margin was good. It's true that half our business is in the Americas. So, going back to the micro, and this is why macro and micro don't always go together. We had almost 10% drop in GDP in Brazil in the last 3 years. We doubled the number of customers in Brazil. So our digital customers went up. We see opportunities for bringing people into the economy through financial inclusion. We've developed tools in Brazil where, we hope to have 1 million people in 2-3 years who are being bankerized by new technology that we're able to develop. So I think, again, going back, negative rates, the question there, and you can see that I'm just telling you what I want to say. I'm not answering your question.
That's fine.
But I think I've said, we all agree that monetary policy has been very important for Europe, for the world. The question is, how much more can it do? And the question is it really doing its purpose, which at the end, and again, in Europe, it's mostly, the transmission is through the banks. And so some analysts, and these are numbers written, calculating that European banks in the next 5-6 years need another 400 billion in capital. So you can have all the liquidity in the world, that if you're asking banks for more capital, the transmission is not going to work as well as it should. And there's evidence that in many countries, actually, the demand is not growing as rates get more negative. Let me stress more negative.
Right.
So I think the policies were the ones that we needed. But again, growth is going to come from these opportunities. I mentioned Latin America, but in Europe, there's also opportunities. Green finance is one of them. We have committed 120 billion in green finance in the next 5 years. And so there's lots of opportunities to do, to support new sectors of the economy. But we need it all to work together, of course. At the end, the macro and the micro have to be
come
aligned.
together.
Yeah.
Daniel, good numbers out earlier this week for the last quarter. How does the interest rate environment color your perspective going forward? And to Anna's point, is it diminishing returns on lower rates, especially given the 16 trillion in negative yields?
I think that monetary policy and negative rates. So first, monetary policy has probably a less of effect than it used to have 30, 40 years ago, as the population is getting older and the patterns of consumption changes, as the distribution of income changes. So negative interest rates doesn't look to be beyond where it is today, the possibility of boosting the economy as much as we saw it. If anything, it could be probably the opposite, because if you see that rates are going to be so low for so long, you start getting concerned about the future and consume less today. So for me, it's more about the mix of monetary policy and fiscal policy and what is going to maintain the economy going, more than just keep going into one tool that probably is being used as much as is possible to use. For the business, really, obviously, we prefer higher interest rates and lower interest rates in general, but it doesn't make a huge amount of difference. For sure, it makes a very little difference in the wholesale business for ourselves, but it does create challenges in sectors like the insurance sector or the pension sector, that they have certain liabilities. As rate goes lower and lower, it gets difficult and more difficult to match, and they are forced into taking more and more credit risk, in the sense that who knows how that one is going to play out. So there is not all positive about lower interest rates, so I think that we need to be careful and balance policy a bit better than it is today.
Takashima-san, the Bank of Japan has been in the QE business for seems like as long as I can remember, and Japan is oscillated on fiscal policy of consumption tax, no consumption tax. The date continues to be pushed back. How do you bank in an environment, the current interest rate environment in Japan, and how much longer can the Bank of Japan continue this policy without it having detrimental effect, if not on the major institutions, but certainly the regional banks in Japan?
That's the question. Last thing I wanted to respond back, and Yes, it's a challenging environment. There's no question about it. But if we take a look at the structural issues in Japan, even with the current low interest rate and the negative interest rate environment, there is a significant needs for the transformation of the industry, such as the all of small businesses in Japan. Almost 70% of the management of those small businesses is over reaching 70 years old. That means there is a significant needs for succession of the businesses, and those needs, the financial institutions functions as go between the introducing those businesses with other managers or other companies that will lead to the significant opportunity for the financial advisory for acquisitions or introducing some of the good managers. Even within the SMBC, we have 130,000 small businesses accounts. We have all those, the credit relationship with all of them, and the same thing, 70%. It's just older than the 65 years old. So there is a significant need for the next 10 years, 20 years, as the financial institutions to deal with those fundamental issues. That's one example, in addition to the comments Anna just made related to the function as a financial institution, even under the most challenging interest rate environments. And one thing I just like to point out, very the specific to the Japanese situation, that is the fact that the both corporate and the household sectors has long been in the financial surplus, and only sector in the cash the deficit has been the government and public sector. So in Japan in particular, the current negative interest rate policy means it's just fiscally the taxing on the financial surplus of the private sectors. So it is, perhaps compared with even the situation in Europe, it is more like a physical tightening tool rather than the monetary easing. That's the really peculiar feature of Japanese situations. That's why, as chairman of the Bankers Association this year, we have been always asking Bank of Japan to take a really close look at careful examination of the balance between the merits and also the side effects of the current.
I wanted to ask about the connection with the micro and the macro, and demographics play a big part. And let me encourage the audience to please feel free to use the app on your phone or iPad to send in questions, and I will lob them in as they come across the transom. Jose and Shamira, let's talk about Asia and China. This morning we saw softer numbers out of China. Not a big surprise. The trajectory is pretty much baked into the cake. The China story has become one of a bit nervousness and anxiety given the role that China and the U.S. together play with respect to global growth. Together it's about 40% of global growth. Should we be worried about China's trajectory? Is there stabilization coming? And do we spend too much time focused on China in Asia? Should we be looking at other parts of the Asia story? Jose and Shamira?
Yeah. I think, yes, what is happening in China, I don't think is a big surprise. In fact, a couple of years ago, the intention of the Chinese authorities was to reduce the quantity of growth in order to have higher quality growth, more balanced growth, and they already put the economy on a path towards deceleration. But then came the US-China trade tensions, which have significantly aggravated this deceleration, and which has made the Chinese authorities to put in place counter-cyclical economic policies, monetary policies, now much more fiscal policies, in order to keep growth, I think, around or slightly higher than 6%. And if one looks at the forecast that both the IMF and the private sector institutions are have been making in the last few weeks, they still have Chinese growth, and this is our forecast also at Standard Charter. Chinese growth for next year will continue also around 6%. So I think that there is not cause for panic. But it is true that these numbers are very different from the ones that we had in the past, and that the balance of risks is tilted to the downside. This is why I think it's so important that this partial trade agreement between China and the United States opens the door to a more constructive relationship on trade issues, hopefully on other issues also down the road, although these are even much harder to resolve, that may bring back some of the trust that now has been so much diminished in the world, and particularly around US and China. But I think one needs to look beyond China as well. And we have a very important economy, which is India, right? And India is now, after a few months after the elections, has the opportunity to put the economy on a path which is better. It was an economy which was growing at 8%, it came down to 7%, now it's 6-point-something%. The government is now putting in place measures to more decisively address the problems in the banking system and in the non-bank financial companies, which is very important. And of course, banks are the engine of credit and crucial to support growth. So if the government is going to do more there, more action to clean up, I think that this is good news. Infrastructure spending, and then structural reforms. And then you have another very large economy which contributes to global growth more than the United States by itself on a better track. And I think that's very important. So you have between China and India a contribution to global growth of about 55% among the two of them. And then we have other economies in Southeast Asia, like Indonesia, like, which is doing well. It has tremendous potential, population, in terms of the infrastructures that they're putting in place. So I think there are other economies that we need to look at and that they are a source of upside going forward. So let's remember, Asia, emerging Asia, is still the fastest growing region in the world. It's a 6% growth region, and that's double the 3% that we have now. So I'm positive over the medium term on Asia, in spite of the fact that there may be some important hiccups over the medium and short term.
Shimari, do you agree with that? And not only about China, but India or other places, Vietnam?
I mean, I completely agree with what Jose was saying, that China and Asia more generally is the growth engine of the world. It's the biggest contributor to world growth. It's also a big source of capital for the world now. And China naturally is maturing, as you say, but in 2012, it was growing at 15%, but off a much lower base. It's growing at 6% now off a bigger base. It's contributing the same amount to world growth. And we have to accept that it's the second largest economy in the world, and it's a big player now. Now, having said that, China and all these Asian countries are exposed to external demand. So I think in addition to the maturation of the Chinese economy slowing the rate of growth, I think some of these factors will also contribute, including supply chains diverting, although China provides so much capacity that it's hard to see a big proportion of that move quickly, but places like Taiwan, South Korea, Vietnam are now seeing big increase in their export rates, especially to the US, 12% I think for Taiwan, 7% for the others. Still not a huge diversion away from China. I think China still is going to be a very big economy and has scope for fiscal stimulus, as you say, beyond the stimulus already being done. But the other thing that's happening is I think China's going to focus much more in its region, and there's a big consumer base growing there in China. And, if you look at mobile payment transactions in China, there's 140 times as many happening as in the US. So this is an economy that's, growing basically in today's age, that's moving very rapidly to adopting technology, etc., and the consumers stepping up. So I do think China and Asia will be big contributors to world growth and also big capital providers, in that if you look at the 10 biggest sovereign wealth funds in the world, 6 of them are in China. If you look at the 10 biggest public pension funds in the world, 3 of them, China or Asia, sorry. are in China, Asia. So I think these regions, yes, China will slow, others will grow, but it'll be a big player in global growth as well as capital provision.
You use the T word, technology.
Yeah.
Maybe I'll shift the aperture of our view a bit to the digital space. You and I got together for coffee a week or so ago. Most of our conversation was really about digital challenges, Europe specifically, but globally. Is there a technology arms race going on among and between financial intermediaries? And how important is it to have a level playing field with internet platform companies? I mentioned it in my opening remarks, but I know you feel strongly about it.
Yes, so, yeah, I feel very strongly. Yeah, you know that very well. There is the structural changes in the economy driven by consumer behavior, which in turn has been driven by the adoption of mobile, basically, and what has enabled that means that the way we are, both running the rules in the economy, the way we're taxing companies, the way we think about competition has to fundamentally change. If you think about the changes that we as consumers and businesses have experienced over the last 10 years, how we run our business, how we live, and the changes, as always, from the political side, from the rule, it's always looking at the rear mirror.
Right.
So just one very simple example. When I arrived to my current role at Santander 5 years ago, we had just had approved in Europe what we call PSD2. I remember having coffee here with the editor of a major newspaper, and I said PSD2, and he looked at me like I was, saying something crazy. I said, yeah, it's the Payment Service Directive number 2. And so basically, what that directive does, by the way, it's coming into force now, 5 years later, and it was designed 7, 8 years ago. You can imagine the changes. And so what this directive basically does is it tells banks, you have to give all the information on Tim. For the last 30 years, you've banked with Santander, or maybe JP Morgan, actually. Actually, no, because in the US, you haven't gotten that far.
No.
Not yet.
Which is one of the reasons Danielle smiles more often than I do. So Payment Service Directive basically regulates payments for banks. Now, if you think about who does payments in the US, Zelle has now, I think, the number 1 P2P payments, just thinking about consumer payments, but the number 2 is a non-bank. In Europe, it's the same. And so we need to think, and there's a great paper by the Financial Stability Board, FSB, I encourage everybody here to read it, which has a very important line, a bit late, but better late than never, saying there is a great point to be made for activity-based regulation.
Exactly.
Activity-based regulation. So if we think about what is a payment company, we think about what is a hotel company, by the way. I'm not just talking about banks, except here we're all banks. This has to fundamentally change, and it's not an easy one. We have to sit around the table, but it's not rocket science either. We just need to get it done in the proper way, and it's super important. Where does value get created? And I can see here Davide, who has been very outspoken, so please go online and watch what he says, because I cannot say it as clearly as he does. But the fact is, when you export a car from Germany, the value is created in Germany. When you're selling digital advertising in Spain, where is the value being created, right? Just think about that. And there's many, many examples. So we must fundamentally rethink, and I say it's a new social contract, there's all sorts of names for this, but the way we organize the economy has to reflect that we're in a digital area. And by the way, this has societal implications, fiscal implications, when the budgets don't align in certain countries, it's not just because growth, and again, growth in Europe has to get faster, it's because of many other reasons that we need to understand. So I am very, very passionate about this. I think we should all be, and we should all care about getting this right. And by the way, we need to get it right as soon as possible.
I agree. Activities-based, level playing field, symmetrical relationship.
Right. For competition, for regulation, for taxes. These are very important areas, and they're all interrelated. And again, I'm not talking just about banks. I'm talking about the economy in general. I can go on and
No,
on about this.
no. I know your point of view.
Please.
And here, I think you can, Zelle, for example, we're now doing P2P payments. I mean, there's all sorts of things that, and just one last thing, because I think it's important between US and the Eurozone. There are the rules that we're applying in banking, for example, and that goes to my previous point on how banks can support the economy. And we need banks to be strong, and I think we've done a huge job on that. We also need to support the economy. So level playing field among banks is also hugely important. Let me just give you two examples where American banks and European banks are not playing by the same rules. One is securitizations, which in Europe are extremely difficult. If we could just securitize faster, we could have billions more loans to the economy, so QE might work better. And the other one is another one related to technology that, as you know, we've been trying to get on the table, which is software.
Right.
In a world...
Accounting treatment.
Right. I mean, American banks can capitalize software. And I think that's a great thing, by the way. Software is an asset, and the best proof is, look at these huge companies, American companies, it's all about software. In Europe, we cannot treat software as an asset. Again, when we think this as a very high-level thing, just think again, because if I can spend an extra 500 million on investing in digital, that's going to benefit 140 million consumers and 5 million businesses. So there is a relationship between regulation, fair level playing field, and growth and jobs. And this is what we need to get across as banks, because it seems like, the sentence that gets me more upset is when people say, oh, the real economy, and then like us. I mean, we are the real economy.
Yes. Daniel, JPM's technology spend, I know $12 billion a year, $13 billion. It's a huge sum of money. Yeah. Some of our U.S. firms refer to themselves as technology companies, not financial institutions. How important is the technology spend? And is there a technology arms race? There's a sense that you've got to spend and spend.
So I agree with all the points that Anna has made. So
I always agree with Anna.
Clear on of course, from the regulator, I think that we should walk towards that. But we are where we are today, and you have to really the competitive advantage of smartly investing in technology is so humongous that it is very important you do it. But how you do it is also important too. I am very focused in the company with Jamie and the rest of the management team in really, because the difference between JP Morgan and new company like Google or Amazon, so their technology is very new. So for $1 of investment, they get a very high output. In a company like JP Morgan with a lot of legacy systems, per $1 of technology, you should get less of that good output. And I believe, and I'm very focused on how we are going to use these $12 billion in a more effective way to really create client services. They are superb and all that. And we've been working on that in the retail business and the wholesale business. So on the payment space, I think that the opportunity is humongous. So we have put together all our wholesale payment assets in one business, from treasury services to merchant acquire, from commercial car, and really investing very, very heavily in transforming all our technology stack to be able to compete to whoever it comes, from banks or non-banks. On the trading system, on the trading space, and in the markets business, unless you are really heavily invested in technology, it's pretty much impossible to compete. Because in the past, I'll give you just one example. So asset managers in the equity business, they were getting together with us once a quarter or once every 6 months and telling you, well, you were good in research, you were good in execution, you were more or less in access, so they give you X% of the wallet. That is really going away at a very, very fast pace. Today, what we have is our algos that are executing and algos that they are controlling from their side the quality of the execution. Right. The second that you are not doing a good job, the flow diverts somewhere else. Right. So unless you're really constantly investment at best in class, you will lose your market share in a second and a half.
Takashima-san, to that point, my last trip to Tokyo, I saw Alipay kiosks everywhere. I can pay with Alipay now. Ant Financial is a huge financial intermediary. I know they have 500, 600 million customers. How competitive are the Chinese institutions, especially the non-bank platform institutions in Japan and your other markets?
Sure, it should be the quite a significant threat if Chinese, the companies get into the Japanese, retail market to deal with all the payments or other services. But the reality is not like that. Because in the Japanese retail payments system, all the banks is taking care of the all retail the payment system, whatever the measures, whether it is credit card, debit card, or whatever it is the QR code-based payment system, which so many newcomers, just trying to introduce into the market. But all of the payments, banks and also as a U.S. system, banks and some specific service companies is taking care of all those payments. So I think there is not just the area for competition. Rather, I believe there is more way to cooperate each other, to have better data, and to create the new services, even from our standpoint. And I just add to that comments, other areas, other merits of the technologies, particularly the data and the AI. In the Japanese market, as you know, the Japan is the most advanced aging society. There's so many elderlies needs to be served by the financial institutions and the banks. And as you know, the older you get, perhaps you have to switch from children to take care of to the dogs first. But if your pet is dogs, you have to take a walk every day. So the more older you get, you will change from dog to cat. And what happens after that? Over 80 years old, 90 years old, they are going to switch to the robots. That's the way. Yes, I'm serious. I see all those trends. And those, the AI and the robotics is really supporting those, the aging society. So there is a significant potential of using data, not just in the financial services, but non-financial services, to create solutions to social, the needs. As just an example of potential of data, we have to, of course, deal with all those, the issues as Anna pointed out. As long as there is this right configuration of holistic issues in place, I think we have substantial potential.
Thank you, Takashima-san. Jose, at our board meeting yesterday, we spent a significant amount of time on a topic that wasn't even a part of our agenda 2 years ago, the green sustainability agenda, under a larger banner of ESG. And I must say, our work streams went from nothing to, we have now 5 work streams. Our Sustainable Working Group has 150 institutions. It really is taking off. How are you, Standard Chartered, thinking about sustainability, the green agenda? What are the challenges you're facing, and what are some of the opportunities? And same for you, Shimera, as well.
Well, thank you, Tim. By the way, on the previous thing, on the technology arms race, I'd like to speak more about a race to the top.
Sure.
To help the client and to serve the client, to give it a bit more of a positive meaning. On the sustainability thing, this is something which is very critical for the bank. It happens that our institutional colors are blue and green. And we want to live by these colors because these are the colors of sustainability. And this is something which we take very seriously. This is something that we have embedded in our sustainability philosophy. We have made very important changes to the internal governance of the bank so that sustainability is part of everything we do. We, of course, are very clear on our corporate goals, but we want to make sure that sustainability is a dimension which is present in every decision we take. And this is critical for the emerging markets and developing economies in which we work. Those economies are half of global GDP, but they really only get a fraction of the private capital flows that they need in order to foster sustainable development. A couple of days ago in New York, under the sponsorship of the United Nations, we launched the Global Investors Alliance for Sustainable Development. Standard Charter is part of it. I think Santander is also part of it. There are a number of other financial institutions, members of the IIF, who are part of it and beyond the IIF. So I think that's a very good initiative. But in our particular case, we are earmarking our financing, first, to do no harm, and second, to do good. For instance, we took the decision late last year of stopping any new coal financing anywhere in the world, and to use the money that would have gone into that into providing, financing for clean energy. We have been behind the issuance, helping the Republic of Seychelles of the first blue bond in the world, oriented towards preserving the marine biosphere. We have created the first sustainable deposit in the world, where the money from the deposit is earmarked to fostering the goals of the sustainable development goals of the United Nations. We have issued the first Islamic green loan in the world, where the interest rate comes down for DP World. The interest rate comes down if the emissions come down. And we are trying to put in place, and this is something which has been done by other financial institutions, methodologies for tracking, for measuring and tracking our sustainability impact, our environmental impact, through all the activities of financing that we have with our clients, so that we can measure, establish targets, track them, and then facilitate the transition towards a lower carbon economy. So climate change, sustainable development goals, very critical for us, and putting a lot of clout into helping in this very fundamental endeavor.
Shemara, you as well.
Look, our corporate colours are not blue and green, they're silver, but we still are very focused on this climate change theme. And look, like technology, any of these big disruptors going on in the world create a lot of challenges, but also a lot of opportunities. So, decarbonisation is a huge issue for the community, for our planet today. We really are destroying the planet in terms of what we're doing. Having said that, it's not going to happen overnight. There's a ton of not just capital, but expertise needed to develop the solutions that are needed. And that's going to take a long time. So, yes, a lot of people are saying, let's get off coal. Coal provides the majority of the capacity to the world energy system today, and if we shut it down, people are not going to be able to get heating and water and all sorts of things. If we shut down fossil fuels, we won't be able to move around. A lot of us wouldn't be here in this room today if we hadn't been on an aeroplane. So the reality is it's going to take time, and I think what's really needed is solutions, and that's what we're very, very focused on, is trying to, in the energy transition space, develop solutions to try and bring down the cost of solar, wind, all these things that are coming down already, address the intermittency issue then that comes from them, so we need firming solutions, address the grid augmentation and optimization that's needed as a result of that demand management, and that's just in the energy space. Agriculture is a bigger emitter than energy, and we need to be focusing on precision farming to deal with less fertilizer. We need to be coming up with better feed for livestock so that they don't emit the methane they do when they digest food. Transportation is another huge emitter, and so electric vehicles and ways to find fuel for them. Buildings, heat, so many things need to be addressed. It's beyond what we alone can do. There's a massive journey here. And, going back to the very first point of driving value, that's a place that we could all get together as the providers of capital to the economy, work ourselves and with our clients to try and address this particular challenge. Because, as I said earlier, we may be saying we're in a low interest rate world, but there are opportunities to deliver value where there's structural change like this. And I would note that, being ever the optimist, that the world typically does grow at around 3% plus or minus a bit. We had a big drawdown in the GFC, but we've had low yields for a long, long time now. We've lived with them for 10 years, or in Japan's case, a lot longer than the rest of us, Takashima-san. But we've still had growth, and we've still had corporate profits growing strongly for the last decade. So my view is if we address some of these challenges, we not only do good for the community, we do good for businesses and investors. So we're very committed, despite our silver holy dollar logo, to trying to deliver some community outcomes here.
Wonderful. And I'm going to give you the last word. Santander, you signed the Principles for Responsible Banking. What's your corporate posture toward environmentalism, sustainability?
So, we're very committed to doing responsible banking in general. Climate change is one of the areas. So 5 years ago, I said that, for us being responsible means clearly doing things in a different way. And I think as banks, going back to 140 million customers, if we do our job with our customers in climate change, but also in financial inclusion, we have defined it for Santander, doing things, and each bank has its own, doing things in a simple and personal and fair way for our teams, our customers, our shareholders, and our communities. And we see this as a virtuous circle. And for each company, and this has to be aligned with the purpose of the company, for us it's helping to tackle two global challenges. One is sustainable growth, which includes green, and the other one is inclusion, which is linked to digital. If I can approve on my mobile phone, as I can today, in 10 minutes, a new loan to a micro-entrepreneur, who, by the way, tends to be a woman in Brazil, instead of in 10 days, that makes a difference, and that's responsible. If we can help finance green energy or commit to not having plastics. And so I think what's important is that each company defines what it is, what strategy makes sense for them, including for shareholders. Second, that we have clear targets. And so one of the ones we have committed is to have 10 million people empowered financially in the next 5 years. And third, you need a clear governance. And I think those are the three things companies have to figure out and commit. And I think collectively, we need to find, there's so many rankings and metrics, we need to simplify this. Otherwise, we just keep on getting us to, we signed the UN, as you know, but the list is endless.
Right. We need consolidation in this approach.
So I would suggest the way they say consolidate banks, consolidate the responsible banking entities that are going to be measuring us. And by the way, one last thing is that there's a negative from investors if we don't do this, but we also should get much more of a positive, right? And so this is also important. How do we change? And again, JP Morgan and others that are big in the investor side, how do we make sure investors, give us a premium when we do this well?
Anna, thank you. Daniel, Takashima-san, Jose, Shamira, thank you for coming here today. Ladies and gentlemen, a round of applause for our guests.